In Chapter 7, we have 3 learning outcome statements to understand bond characteristics and bond terminology, to apply time value of money to bonds in order to price bonds and determine yields, and to understand the basic bond relationships. What you'll discover in exploring Chapter 7 material is that it's basically taking Chapter 5 and 6 concepts of present value of lump sums and annuities and applying that to bonds, but it is significantly important that you understand the bond terminology. So it's recommended that you study the bond terminology before you even read the chapter. There are 2 pages of bond definitions and risks that are given in the course notes right before Chapter 7. So again, you should study those definitions very carefully even before you read the chapter on bonds. Here are some handy tips that will help you as you study each chapter throughout the semester. You should work the examples in the rectangular boxes found throughout most of the chapters one of 2 ways. Either pause the lecture as you go along and work those practice problems in the rectangular boxes as you go, or you may choose to watch the entire chapter lecture and then work those practice problems in the rectangular boxes after you've completed the chapter, possibly even a day or 2 later to refresh your memory on what was covered. And the answers to those practice problems in the rectangular boxes are found at the end of the chapter within the course notes. So the solutions to all the examples in the rectangular boxes are actually in the course notes themselves. You should work the supplemental homework practice problems that are found at the end of most of the chapters. The solutions to those can be found one of 2 ways. I actually work them using the document camera, and the solutions are posted to iTunes U, so you can watch me actually work them out and discuss them as I go on the recordings posted to iTunes U. Or if you just want to see the final answer, there is a PowerPoint file posted to Blackboard that will give you the final answer to those supplemental homework practice problems. These are of critical importance. You should work them on your own before you check the answers to those. By doing so, you can correct any mistakes you might have made. Certainly look at the answers, but I encourage you to work them on your own before you check the answers. There will be a Connect assignment that covers the material for every chapter. You should check the syllabus for the due date of the Connect assignments and what chapters it covers. Some Connect assignments cover more than 1 chapter, so check the syllabus for the due date of the Connect assignments and what chapters are covered on those Connect assignments. For the exams, you should check the syllabus for the date, time, place, and the chapters covered for each exam, and you should begin studying early. We allow you to use a half sheet of notes on the exams, and you should start preparing that early. For the final exam, we'll give you a specific sheet that you'll need to use, but for the other exams during the course, you can use a half sheet of notes as indicated on the syllabus. In Chapter 7, we're going to apply the time value of money functions from Chapters 5 and 6 to bonds. So in Chapter 7, it's important that you understand the basic bond terminology. The course notes include 2 pages of bond definitions. If you understand those bond definitions on pages 88 and 89, then it makes learning bond characteristics a whole lot easier. Also, the risks of the bonds are explained there at the bottom of page 89. So please study those bond definitions carefully before you study the notes on Chapter 7. If you've looked at those bond definitions, a few different terms there relate to the risks of bonds, namely mortgage bonds, debentures, and subordinated debentures. So in this first part of Chapter 7, we look at the relative risk of 5 securities here. Mortgage bonds, debentures, subordinated debentures, preferred stock, and common stock. And those are listed from the safest to the riskiest. So let's talk about why that would be the appropriate ordering there from safest to riskiest. First, we know that stockholders have a residual claim on the firm. They get what is left over. They come last. Preferred stockholders have some preference over and above the common stockholders, so they would come before the common stockholders. But Chapter 7 deals with bonds, so the relative ordering of these first three is of primary importance in Chapter 7. The safest of those three debt securities would be the mortgage bonds because they are secured. Specific assets of the company are pledged to secure the mortgage bonds. So if the firm fails to make the required payments on secured mortgage bonds, then the bondholders, through their trustee, could foreclose on those assets that have been pledged to back up the mortgage bonds. It's just like a home mortgage is secured by the home. So the lender can foreclose on the home to satisfy the mortgage against the home. The second and next safest class of debt would be debentures. Debentures are unsecured debt, so there are no specific assets pledged to secure debentures like there are for mortgage bonds because debentures are unsecured. So the specific assets that secure the mortgage bonds can be sold to pay off mortgage bonds. There's nothing specifically pledged to back up debentures. Simply the creditworthiness of the issuing firm is what backs up the debentures. The firm doesn't want to go bankrupt, so they are inclined to meet the obligations of their debentures, but no specific assets are pledged to back up those debentures. The third safest class, which is the least safe of the three debt types of securities, will be the subordinated debentures. By definition, debentures are unsecured, so subordinated debentures are unsecured debt, but they also take a lower standing below the regular unsubordinated debentures. Just like on the job, a subordinate is somebody who reports to their boss or their superior. The subordinate is of a lower order. Subordinate is lower order. They take a lower standing than the debentures. So when you buy a subordinated debenture, you understand that the mortgage bonds are paid first based on the specific assets pledged to secure the mortgage bonds. Then the debenture holders get paid, and after that, since you are of a lower standing, if anything is left, your subordinated debentures could get paid, and then preferred stockholders and common stockholders might get something. So if a firm is liquidated or facing financial hardship, then we would see the payments made basically in that descending order. So the risk becomes greater and greater because you're becoming less likely to get paid if the firm experiences financial difficulty. Now, let's apply the time value of money functions from chapters 5 and 6 to bonds. The price of any security depends upon the amount of cash flow you expect to get, when you expect to receive it, and the risk or part of that being part of the required rate of return or the discount rate that is appropriate for that investment. So risk is an important component of the value of a security. To price a bond, we take the present value of all the future payments that we're supposed to receive. Just like any investment, the value is equal to the sum of the present values of the future cash flows that we expect to receive. We'll discount those cash flows at the appropriate discount rate, what we call the cost of debt or the yield to maturity on the bonds. Now, yield to maturity is an APR type number. So it's just like chapters 5 and 6. We were discounting cash flows at some APR that had to be converted to the appropriate discount rate per period based upon the compounding frequency that was being used on that particular investment. So a YTM, or yield to maturity, is the discount rate on a bond like an APR. So if it's a semi-annual bond, we'll cut the yield to maturity in half. If it's an annual bond, we'll just use the yield to maturity to discount the cash flows. Think about a bond as a package of cash flows. It is really two things. It is an ordinary annuity of coupon payments and a lump sum future value paid at maturity. That is called the face value or the par value. So when a bond matures, it pays the bondholders the par value. Along the way, it pays the coupon payments. And those are all the same amount, the same time period apart for a finite period of time, paid at the end of each period. So those are an ordinary annuity of the coupon payments. So for example, 7-1, we have a bond with 7 years to maturity. It has a 10% coupon rate with annual coupon payments, and the face value is $1,000. That is the typical face value of a bond. So if we're not told otherwise, we will always assume that a bond has a $1,000 par or face value, and that's what will be paid at maturity. We want to draw the timeline for the bond, so we need to know how many coupon payments it will make. And since it's an annual bond with 10 years to maturity, it will make 10 coupon payments. The 10th one will be made at the bond's maturity, which occurs 10 years from now. The coupon payment of a bond is the coupon rate multiplied by the face value divided by the number of coupon payments made per year. So another way to think about the coupon rate is it's the percentage of the bond's face value that is paid out annually. So we apply that coupon rate, multiply by the face value. It tells us how much in coupons the bond will pay out each year. We then divide that by the number of coupon payments it makes per year to get the actual amount of each coupon payment. This will be 1 for annual bonds, it will be 2 for semi-annual bonds, and that would account for just about all bonds. They're either annual or, more commonly even, semi-annual. But for our annual coupon bond here, with annual coupon payments, each payment will be the 10% coupon rate multiplied by the $1,000 par value of the bond divided by the one payment per year, since it is an annual coupon bond, so each coupon payment will be $100. The lump sum future value is the $1,000 par value that will be paid at maturity. So the bond's timeline looks like this. The bond pays you nothing today. This is when you buy the bond. 1 year from now it pays you $100. 2 years from now it pays you another $100, and so on, all the way through until 10 years from now. At the bond's maturity, it pays you the $100 coupon payment, the final $100 coupon payment, and the $1,000 par value. Those occur at the same time upon the bond's maturity 10 years from now. Well, let's calculate the price or the present value of this bond using discount rates of 9, 10, and 11%. Something to think about before we do that, though, is how much cash will you get from this bond in total over the 10 years? If you buy it today, you'll get a $100 payment each year for 10 years. That totals $1,000. And you'll get the $1,000 par value 10 years from now. So you should get a total of $2,000 if the issuing firm does not default on the bond. You'll get $2,000 back over the course of the next 10 years, and you can see when and how much those payments will be as you receive them. So a total of $2,000 should come your way as you buy that bond. Now, let's price this bond using a 9% discount rate. The bond is an ordinary annuity of coupon payments and a lump sum future value, with two things going on simultaneously. So in this case, for the bond, N is two things. N for a bond is the number of coupon payments, 10. There are 10 annual coupon payments on this bond, each payment being $100. 10% of the bond's $1,000 par value is paid annually. So there are 10 $100 coupon payments. N is also the number of periods until the par or future value will be paid. So N is two things for a bond, and fortunately they're always the same thing. It's the number of coupon payments, and it's the number of periods until the par value will be paid, and those are always the same. So we're able to enter everything into the calculator at one time. Number of payments, number of periods till the par value is paid is 10. We're discounting at 9% per year, so everything's on an annual basis for this annual coupon bond. 10 is the number of years, 9 is the discount rate per year, $100 coupon payment is the payment per year, $1,000 is paid one time as a lump sum future value. So when I compute the present value, the calculator will discount all 10 of those coupon payments at 9% per year, and it will discount the $1,000 par value 10 years at 9% per year and add up all of those present values. When we do that, then the calculator will tell us the present value is negative $1,064.18. Since we are more likely to be a bond holder than we are to be a bond issuer, it should make sense to us that from our viewpoint, the payment is positive and the future value is positive because we will receive all of those cash flows. We'll receive the $100 payments. We'll receive the $1,000 future value. In order for that to happen, the present value is negative. We have to pay out the price to buy the bond today. We have to pay $1,064.18 today in order to receive $100 per year for the next 10 years and $1,000 at maturity 10 years from now. If I pay this price and I receive these cash flows as I promised, then I will be earning a 9% return on my $1,064.18 investment. If I discount the cash flows at 10%, I'll get a price of $1,000, and if I discount at 11%, then I will get a price of $941.11. Now let's illustrate this one on the calculator, which should be fairly obvious, but just to make sure we're on the same page, clear the display, second, clear TVM. 10 is the number of payments and the number of annual periods till the par value is paid. 11 is my discount rate. $100 is my coupon payment amount. $1,000 is the par value to be paid one time at maturity, and then I compute the price of the bond and I get $941.11 with the minus sign in front of it because I will pay the $941.11 if I want to get the $100 payment and get the $1,000 future value. So for those three different discount rates, we recap the different prices here. So when I discounted the cash flows at 9%, the bond was worth $1,064.18. When I discounted the cash flows at 10%, the price was $11. And when I discounted 11%, the price of the bond was $941.11. A bond is an ordinary annuity and a lump sum future value. So when I discount the cash flows at a higher rate of return, the present values go down, the bond price is lower. So we see the bond prices and yields are inversely related to one another. When we discount at a higher rate, the bond's value would be lower, everything else equal. Also notice that the yield to maturity, or the discount rate here on the bond, when it's compared to the coupon rate, it tells us something pretty important about the bond's price. So look at this 9% discount rate here. When I discounted the bond's cash flows at 9%, okay, compare that to the bond's 10% discount, 10% coupon rate. If I discount the cash flows at 9% and the bond's coupon rate is 10%, in fact, it is always 10%, it will always be 10%. The coupon rate cannot change. It is set when the bond is issued. Okay, we're not dealing with any sort of adjustable rate bonds or anything like that. When the coupon rate is set, it does not change. That's because historically the bonds were issued in paper form, and the coupons were actually in paper form printed when the bond was issued, and you clipped them off and redeemed them through your bank. So there was no way to change the coupon payments after the bond was issued because they were already printed and they became due every year or every semi-annual period, let's say, when the coupon became redeemable for the amount of the coupon payment. So the coupon payments will not change, the coupon rate will not change after the bond is issued. That is set in stone. But the discount rate can change as market rates of interest change, or perhaps the perceived risk of the bond changes. Investors might require a 9% or 10% or 11% return on the bond. So this discount rate can change, the coupon rate cannot change. So when we compare our discount rate here of 9% to the bond's coupon rate of 10%, then we have a situation where the bond is paying relatively attractive coupons. It's paying coupons at a rate of 10%. But you and other bond investors agree that the bond should provide a yield of 9%. In that situation, you'll see the bond will be priced at a premium, a price above its par value. That was 1064.18 when the discount rate was 9%. Now, one might get the perception that if you pay more than the par value for the bond, you're going to lose money or something like that, but that's not the case. Remember, this bond pays $100 per year for 10 years and $1,000 at maturity. So the total cash flow you expect to get is $2,000 from the bond. If you pay 1064.18 for the bond, you'll be earning a 9% return on your 1064.18 price. The reason you're willing to pay a premium price for the bond is because the coupons are relatively attractive. The coupons are being paid out at a 10% rate. Given market rates of interest and the risk of the bond, you deserve only a 9% return. The coupons are relatively attractive. You're willing to pay a premium price of 1064.18 for the bond. That will give you the 9% return over the bond's life. Even though the coupons are paid out at a 10% rate, you'll only earn 9%, which is fair. You'll only earn the 9% return because you paid a premium price for the bond. So you pay 1064.18, the bond only pays $1,000 at maturity. You have a little capital loss in there, and so your return will not be the 10% coupon rate. It will only be the 9% rate that you used to get this price in the first place. If you discount the cash flows at 10%, which is the same as the bond's coupon rate, then the bond will sell for its par value, $1,000 in this case. So when the discount rate and the coupon rate are the same, 10% in this case, the bond will sell for its par value of $1,000. When you discount the cash flows at the higher 11% rate, a rate above the bond's coupon rate, then you see the bond sells at a discount of $941 price, which is below its par value of $1,000. So you got a discount price in this case when you discounted the cash flows at 11% instead of 10%. Now, if an investor had their choice and could look at these three options at the same point in time, we'd probably all agree I'd rather to pay $941.11 instead of $1,000 or $1064. But these are different prices that come from different discount rates we use just to show how the bond price compares to its yield. When we discount at a higher rate, the bond price is lower, and vice versa. So we don't get to select from these three choices. We would have to pay whatever the market price is to buy the bond. If we could buy it at a discount of $941.11, we would expect to earn 11% on the 10% coupon bond. If we were willing to pay the premium price of $1064, we would be willing to accept only a 9% return on the 10% coupon bond. When you pay a premium price for the bond, it shouldn't surprise you, your yield will actually be below the bond's coupon rate. You're paying a premium, your yield will be below the bond's coupon rate. If you can buy the bond at a discount, your yield will be above the bond's 10% coupon rate because you pay $941.11 to buy the bond. It pays $1,000 at maturity. You've got a built-in capital gain. So if you can buy the bond at a discount, your total return will actually be above the bond's coupon rate because of that built-in capital gain, paying $941.11 and getting $1,000 back at maturity. Now this is a graph of those three bond prices related to their yield. So when we priced the bond at a 9% yield, we got the 1064 price. When we priced it at the 10% yield, we got the $1,000 price. And we priced it at the 11% yield, we got the $941 price. That is the 10% coupon rate for the bond there. That is the bond's $1,000 par value right there. So look at the quadrants of the graph here. In particular, think about what happens at points where the yield is set down here below the coupon rate versus when the yield is exactly equal to the coupon rate and when the yield is set at a rate up here above the coupon rate. Where the coupon rate and the yield being this whole x-axis here, and the coupon rate being this 10% point on the x-axis. At the point where the yield and the coupon rate are both 10%, the bond sells for its par value. At the point where the yield is down here below the 10% coupon rate, that makes the coupon rate look relatively attractive at 10% if you're only entitled to earn 9 or 9.5 or 9.7% on the bond that's paying a 10% coupon rate, then you would get a premium price for the bond. Or another way to think about it, if you're discounting the cash flows at a lower rate down here versus the 10% rate at which the bond is paying out coupon payments, you're willing to pay a premium because you only require 9 or 9.5 or 9.7% on a bond that's paying out 10% coupons. You're willing to pay a premium price because those coupons are relatively attractive. At the point where you require a return above the 10% coupon rate, 10.5 or 11%, you can't squeeze a 10.5 or 11% return out of a bond that only pays 10% coupons unless you buy the bond at a discount and have that built-in capital gain. So the way you get additional return above and beyond the bond's coupon rate is to buy the bond at a discount and have that built-in capital gain. Now let's think about a semi-annual bond. Remember, the coupon rate is for the entire year. So in our bond here, it's the same bond as we used before that had a 10% coupon rate with 10 years to go. But now that 10% coupon rate is paid semi-annually. We'll initially price this bond here with a 9% yield to maturity. It's still $1,000 par value, 10 years to go until this bond matures, but it's a semi-annual bond. And remember, the yield to maturity is like an APR, so we'll have to cut that 9% discount rate in half to get the semi-annual discount rate. So to draw the timeline for this bond, we've got to know how many payments there are. The bond has 10 years until maturity. Being semi-annual, it makes 2 coupon payments per year, so it will make 20 payments. So N is the number of payments, is 20 for this bond. It's also the number of semi-annual periods until that bond pays its $1,000 par value. The payment is the coupon rate multiplied by the par value divided by the number of payments the bond makes per year. So this bond pays out $100 per year total in coupon payments, $100 per year, but it makes 2 equal semi-annual payments. Each one is $50. So we put those $50 coupon payments on the bond's cash flow timeline. There will be 20 of those. The bond pays its $1,000 par value 20 semi-annual periods from now. Yes, this is 10 years from now, but everything has to be done for this bond on a semi-annual basis, including discounting the cash flows on a semi-annual basis. So we cut the yield to maturity in half and discount the cash flows at 4.5% per semi-annual period. So our calculator inputs would look like this. We have 20 semiannual coupon payments. We're discounting 4.5% per semiannual period. Each payment is $50, and the bond pays the $1,000 par value at maturity. So we'll clear the display. Second, clear TVM. 20N is the number of payments and the number of semiannual periods till maturity. 4.5 is our semiannual discount rate, so everything is semiannual for this bond. The $50 payment amount is the semiannual coupon payment the bond makes, and then the bond pays $1,000 at its maturity. If I compute the present value, I'll see the bond's price is $1,065.04. The calculator put the minus sign in front of it, telling us that we have to pay out this amount up front in order to receive the payment and receive the future value when the bond matures. Current yield is a form of rate of return on bonds that's commonly quoted in the financial press. And current yield just tells you how much you're going to get currently. So in other words, it's what you'll get solely through the coupon payments. There is no par value being received each year, so we're just looking at the return we get solely in the form of coupon payments along the way. For this bond, the price was $1065.04, and it pays 10% of its par value each year. It doesn't matter if that's 10% annually or paid semi-annually, it's going to pay out $100 over the course of each year, 10% of the $1,000 par value. Current yield just expresses that $100 coupon amount over the course of each year as a percentage of the $1065.04 price. So the current yield is the $100 coupons for the year divided by the $1065.04 price, and you get a current yield of 9.39%. You pay $1065.04 today, you'll get $100 over the course of the next year. That's a 9.39% current yield. The yield over the coming year solely in the form of coupon payments. Now, again, look at the bond definitions, study coupon payment versus coupon rate, and look at the bond risks. Bonds are relatively safe, but they still have risk. One risk that's probably the one an investor worries about the most is default risk. Will I get my money back? This is the risk that the issuer will sell me a bond and then not make the promised payments to me, not pay me my coupon payments or the par value when the bond matures. That could negatively affect my return quite seriously if they default on the bond. Interest rate risk is the risk that I hold a bond and interest rates go up. Well, my coupon rate stays the same, so I'm going to be discounting my cash flows at a higher rate of interest, and my bond's price will fall because present values and discount rates are inversely related. So if I discount my cash flows at a higher rate of return, my bond's value will fall. Another way to think about this is that if interest rates fall, then if interest rates rise, the previously issued bonds have that coupon rate that was already set and it's paid out at a lower rate, and now bonds are being issued in a higher interest rate environment. They're probably going to offer higher coupons, so my bond with the old lower coupons is not as attractive and it loses value. So you can think when rates go up, we discount at a higher rate, the bond's value falls, or that it's just bonds not keeping up with the higher rates of interest and other investments are more attractive. Reinvestment risk is the risk that I'll receive my coupon payments and then interest rates will fall and I will not be able to reinvest my coupons at as high a rate as I thought. Now, if you look at the yield to maturity definition on the definition pages, page 88, 89 of the course notes, that yield to maturity is the rate of return you earn if you buy a bond and hold it until it matures. But the only way that works out perfectly is if you're also able to reinvest your coupon payments at that same yield to maturity. So if interest rates fall over your bond's life, causing you to have to reinvest your coupon payments at that lower interest rate, they will not accumulate as much value for you as you thought. So your bond will be adversely affected if interest rates go down, because you'll reinvest your coupon rates at a lower rate. Now, you can see that reinvestment risk and interest rate risk partially offset one another because they're related to interest rates in the opposite manner. Interest rate risk was the risk that rates will go up, causing your bond's value to go down. Reinvestment risk is the risk that rates will go down, causing you to reinvest your coupons at a lower rate. Well, if the rates go down, your bond's present value will go up. So they partially offset one another because they're related to interest rates changes in the opposite direction. So as rates go up, you'd reinvest your coupons at a higher rate, but you'd suffer interest rate risk, which causes your bond value to go down. So they sort of moderate each other, they sort of offset one another, because interest rate risk and reinvestment risk are related to interest rates in the opposite direction. Inflation risk is basically a component of interest rate risk because inflation causes interest rates to go up, and that creates interest rate risk, causing your bond price to go down. Currency risk is the risk when bonds are denominated in a currency other than the investor's or bondholder's home currency. You're going to measure your return in terms of your home currency. So if you buy a bond, if you're a US-based investor and you buy a bond denominated in euros, and the euro loses value against the US dollar, you get your coupon payments and your par value payment in euros, and the euro loses value against the dollar, you'll convert those payments back and they will buy you fewer US dollars. Your return will be hurt because the euro lost value against the dollar. Your bond is denominated in euros, and those euros will now buy you fewer dollars, so your dollar-based return is lower because the euro lost value against the dollar. And finally, marketability or lack of marketability risk is an issue because bonds are not as actively traded as stocks. Most bonds are traded over the counter, so they're not as liquid. There's not as active of a secondary market. So we face the risk that we may not be able to sell a bond for its full value as quickly as we would like to, especially not as quickly as if it were an exchange-traded common stock. So bonds are not as liquid as stock. Now, we talked about yield to maturity a little bit. It's the discount rate on a bond. It's the bondholder's required rate of return. It's the rate of return you'll earn if you buy the bond and hold it to maturity. It's expressed like an APR. So we've seen yield to maturity a few times already. Let's talk about how to calculate it. To earn that yield to maturity, the issuer cannot default. They have to make all the promised coupon and par value payments. The bondholder has to hold the bond until maturity. That's where it gets its name. It's the yield you earn up until maturity if you buy the bond and hold it until maturity. And the interest rates don't change, meaning you don't suffer reinvestment risk, that the coupons can be reinvested at that same yield to maturity. So if those things happen, then you're going to earn that yield to maturity. Well, that means the YTM is the discount rate that equates the bond's price with all the future cash flows you're going to get from that bond. You determine the bond's price by discounting all those future cash flows at the yield to maturity, and that gives you the bond's price. So you could say the yield to maturity is the discount rate that equates the bond's price with all those future cash flows. And it is an APR type measure, so it does not reflect compounding within the year. It's simply, for a semi-annual coupon bond, it's the semi-annual rate that is simply multiplied by 2 to calculate the yield to maturity. So in example 7.4, bond A has a $1,000 par value 10 years to maturity, and 8% annual coupon payments, and it sells at a premium price of $1,100. Well, we know that when a bond sells at a premium price, your yield is going to be below the coupon rate that the bond is offering. You're willing to pay a premium price because the coupons are really attractive, and you're willing to accept a yield below the coupon rate because the bond is selling in a lower interest rate environment or seems to be safer. So the yield to maturity equated with this $1,100 price, if you get $80 per year and $1,000 at maturity, is going to have to be something below the bond's 8% coupon rate because we're paying a premium price for the bond. Now, before we calculate this yield to maturity, remember this. I'm the bond investor. I will pay out the price. I will treat the present value as a negative cash flow. I will receive the payment. That is a positive cash flow from my perspective. I will receive the future value. That is a positive cash flow from my perspective. These will always have the same sign for a bond. This will be the opposite sign. If I'm the bond holder, it makes sense for the present value to be negative and for these to be positive. The issuing firm could turn those signs around, but we're more likely to be a bond holder, so let's make the present value negative and the payment and the future value positive. We see we get a 6.6% yield if we pay $1,100 to buy the bond. To do that on the calculator, I'll clear the display. Second, clear TVM. There are 10 coupon payments, 10 years till the bond matures. $1,100 negative is what I would pay out to buy the bond today. If I do that, I get $80 per year and $1,000 at maturity. $1,000 positive future value, and then I will compute my yield to maturity, 6.6%. Now, that 6.6 is the YTM because I've done everything annually, so that is my annual rate of return or yield to maturity. Here's the same bond basically with a $1,000 price. So I'll change my price to $1,000 negative because I would pay out $1,000, recompute, and I get an 8% yield. And I'll go ahead and do the last example here before I've shown it to you. If I could buy the bond for $900, I would get a yield of 9.6%. So 8% corresponded to paying the par value of $1,000. That was exactly equal to the bond's coupon rate of 8%. And if I could buy this bond for $900, then I got my 9.6% yield. The way to get a yield to maturity that is greater than the bond's coupon rate is to buy the bond at a discount. Another way to think about that, if you require a 9.6% yield that is above the 8% coupon rate of the bond, you're going to be discounting the cash flows at a high rate, higher than what the bond pays out cash flows with an 8% coupon rate. You'll get a present value below the bond's par value. The $900 price will give you a yield that is above the bond's 8% coupon rate. So when we pay $900 for a bond and it will provide $1,000 back at maturity, that's that built-in capital gain that helps get us return over and above the bond's 8% coupon rate. So I can squeeze a 9.6% yield out of an 8% coupon bond by buying the bond at a discount because I'll get back $1,000 at maturity and have that built-in capital gain. Now, the bonds A, B, and C all had the same maturity, the same coupon rate, the same par value, but we saw the bonds selling for $900, $1,000, or $1,100 respectively. And if this is occurring at the same time in the same firm, then there must be some difference in risk on those bonds. The bond with the lowest price must have had the highest risk because we were requiring a higher yield, only willing to pay a lower price for that bond, it must have had more risk. The bond I was willing to pay the $1,100 price, pay the premium price for, must have been the safer, higher quality bond out of those three. So risk will explain why those bonds might be offering the same future cash flows, but the prices would differ, is because I'm requiring a higher return out of the riskier bond. I'm only willing to pay a lower price. I'd be willing to accept a lower return out of the safer bond and be willing to pay a higher price. Now here's bond D, that's a semi-annual bond, and we'll illustrate calculating the yield to maturity for the semi-annual bond that will pay $1,000 par value at maturity in 5 years, but it pays out the 9% coupon rate on a semi-annual basis. So when you see a 9% coupon rate paid semi-annually, that means 4.5% of the par value every 6 months. This is a premium bond as well, so we know that the yield we're going to calculate will be below the coupon rate for the bond because we're willing to pay a premium price to buy the bond. So let's see what that yield to maturity is for this bond. Everything has to be done on a semi-annual basis for this bond. So it has 5 years to maturity. With 5 years to maturity, second, clear TVM, clear the third row. With 5 years to maturity, we can do that in our head on a semi-annual basis. That is 10 semi-annual periods until the bond matures. You pay the premium price of $1,200 to buy the bond, remembering from the bondholder's perspective that cash flow has to be negative because you would pay out the $1,200 price to buy the bond today. With a 9% coupon rate on a $1,000 par value bond, that's $90 per year, but it's on a semi-annual basis. So 9% of $1,000 is $90 per year. Divide by 2, because it makes 2 equal coupon payments per year of $45, then the payment amount is $45 and the bond provides $1,000 at maturity. So when we compute the IY here, that is the semi-annual rate of return on the bond. I put in the number of semi-annual periods, I put in the semi-annual coupon payment, and I'm going to be calculating then a semi-annual yield. So when I get that 2.245 semi-annual yield, I have to double it, and that gives me my 4.49% yield to maturity. Remember, YTM is an APR, so if I calculate a semi-annual rate, which I will always on a semi-annual bond, I'll calculate the semi-annual rate of return. I have to double it to be able to call that my yield to maturity. Yield to maturity on a bond is an APR measure, so I double that semi-annual yield to get a yield to maturity. Now on the semi-annual bond, bond D, we have an opportunity to calculate the effective annual rate because there is semi-annual compounding going on. The semi-annual rate was 2.245%. We doubled that to get a yield to maturity or an APR of the 4.49%. So the effective rate would be 1 plus the 4.49% annual return cut in half, or the 2.245% semi-annual yield. 1 plus that semi-annual return compounded twice during the year with the 1 taken off will give us an effective rate of 4.54%. We could also use the interest conversion feature on our calculator. So remember, second 2 is how we access interest conversion. And when it asks for NOM, it wants the APR, which for a bond is the yield to maturity, in this case 4.49%. I have to enter it to save that value and then go up, and the compounds per year on the semi-annual bond will be 2, and then go up to effective, and I must recompute it, and the effective rate on the bond is 4.54%.